Are you looking to take your personal finances to the next level? Well, you're in the right place. Welcome to the Monday Money Tip Podcast, presented by I Was Broke, Now I'm Not, with your host, Joseph Sangl.
I am so excited to be at episode number 43 of the Top Money Questions Monday Money Tip Podcast. Are you fired up for Top Money Questions, Megan?
I am. That was a different voice.
That's right. That is Megan Hibbard, my co-host. And I am super stoked about this episode because we believe this will be the last one that you do for a while.
I know. Sad
Because
day.
you know what? Baby is going to show up. We're super excited about that. And we're going to be talking in this episode about what specifically? Can you kind of rattle off some of those questions we've gotten this month?
Yep. So today we're answering your questions rapid fire style. So a couple of the ones we have, how is interest on my car loan calculated? What type of life insurance should I purchase? Should I focus on investing or paying off debt? How much money do I need for retirement? What do I do if I get laid off? Stuff like that.
That's
so
awesome.
Good questions.
Yeah, those are great questions. I can't wait to address those, and I like it because they're a big variety. So welcome to the variety show known as the Monday Money Tip. End of the month episode. Fired up.
I feel like you're like a radio DJ now.
I am.
That voice.
I'm a DJ. I've got my radio DJ voice going on.
We need to get you some of those big headphones.
Yeah, people can watch on YouTube to see what it really looks like, though. I mean, we our studio is amazing, and we really do appreciate everybody listening, and we're really working on growing this podcast. Tons of people are tuning in, and so be looking at this YouTube episode every now and then because we're going to be doing some work on the studio.
Yes.
It's time to upgrade. Would you agree?
I would agree.
You guys have helped us be inspired enough to upgrade so that we can serve you guys even more. The podcast is growing, and we're thrilled about it. But now we've come to a magical time of the podcast.
Yes.
Yes, let's go.
Now it's time to get caught up with our current money events.
This portion of the podcast is sponsored by I Was Broke, Now I'm Not. Take your finances to the next level by utilizing their financial tools and calculators. Visit iwbnan.com and click on Tools, Budget Templates, Debt Freedom Date Calculators, Retirement Calculators, Investment Calculators. They're all right there at your fingertips, and they are all free.
That's awesome. And today's current events topic is, I always like to be right now relevant, and I like to bring up topics that many people do not talk about very often and maybe make every single person who listens to this podcast a little more informed, a little more financially intelligent, because financial intelligence leads to something I call financial confidence, and that is awesome. Today I'm talking about unemployment. Unemployment is a very thrilling topic, I know, but really I did some research on this, and I found it to be very interesting. And I first was going to do research only on the United States unemployment rate, but then I found a great resource that shows the unemployment rates of all the developed countries. It's pretty amazing, really, when you're looking at it.
Yeah.
And so today I decided I would give the update on the U.S. unemployment rate, the Canadian unemployment rate, and the Mexican unemployment rate.
Perfect.
The beautiful thing of North America. Is that awesome?
That is awesome.
And so the unemployment rate, the latest one in the United States, is 3.80%. That's really amazing. It's at historic low levels, which is great. In fact, we've been on a long run downward, which has been amazing. In fact, since 2010, it's been declining. And that's really phenomenal. 3.80% is amazing. The current Canadian unemployment rate, now each of these countries calculates theirs a little different. Canada's is at 5.80%. So U.S. is at 3.80. Canada's at 5.80. The common belief is that if Canada measured theirs the same way as the U.S. did, that theirs would be a full point lower than their reported number. So a more comparable number might be 4.8 for Canada. And one of the reasons why, and this is very interesting, and I don't know if this is useful to anyone. It might be a useless fact to know. But one of the big differences in the calculation is that Canada includes 15-year-olds in its calculation. And the U.S. doesn't start including people in the population of workforce until they're 16. So that 1 year difference is a big difference, and as part of the contributing factor to the percentage difference.
They don't have a whole lot of 15-year-olds working.
I don't know. I mean, I know a lot of Canadians that are hard workers, so pretty awesome. And I go fishing up in Canada. I love it. And there's a lot of dock hands. They're working pretty young age, and they're pretty awesome at what they do. But I also have the Mexican unemployment rate, and believe it or not, they're at 3.6%.
Wow.
And so, it's measured by the number of people that want a job, right? So there's a lot of people who are not employed and they are not looking for a job. They are not included in the calculation. So My mom is not employed and she's not looking for a job. She's 78 and she's not interested.
She's
in
living
being
the
employed.
dream.
That's right. So she's not considered a person looking for a job and unemployed. It's people that are actively looking for a job and do not have one. And so that was interesting. And I also went and I pulled statistics and I got some charts that I'll share as well. And they're included in this link that we'll provide in the show notes, where it shows the cyclicality. And if you're watching on YouTube, you can see it right here. But you can see the cyclicality is those are generally in 10-year dates. And in general, it looks like the unemployment spikes about every 10 years.
Yeah.
It's no guarantee. And in fact, it's been on one of the longest runs ever. But every 10 years or so, there's going to be an uptick in unemployment. And this, of course, low unemployment bodes well for workers. It means for employers to keep their employees, they're going to probably have to pay up. It means there's going to be pressure on wages. But also drive up inflation, and that generally leads to recession over time. And so one of the things I would encourage each of you to think about as you're listening to this podcast is, number one, be grateful that there's a time of low unemployment. But number two, it is a reminder that times of unemployment do show up, and it could affect you. And so take this as your warning to stack some money up. Follow the ladder, and I beg of you, get to at least rung 5 and have at least 3 months worth of expenses saved up. Because what do they say? When your neighbor is laid off, that's a recession. But when you're laid off, that's an outright depression. And we want to make sure that you're aware of these numbers, but also just reminded that things go in cycles, save some money, and so that you can still prosper when times maybe aren't as stellar economically. That's it for today's Current Money Events section. Nailed it.
Okay, so our success story today is, here we go. Hi, Joe. We're still hanging in there, and that's a good thing. We're still tithing, something we could not imagine being able to do before. We lowered our cable bill by dropping premium channels that we did not need anyways. We are also in the process of lowering our mortgage interest, which will be a huge help, and that will free us up to get rid of some higher interest debt. And if all goes well, I will be moving to a new work that is better for us all the way around, including what I believe a way to greater glorify God. Thanks for your ongoing support. Continued blessings to you and yours. Dana and Laura.
That's awesome. And so this is interesting. When I'm looking at this, that they're hanging in there, and that's a good thing. That's how they led the statement.
Yeah.
That's pretty interesting because that's really what money is. It's a journey.
Mm-hmm.
And a huge part of winning with money is hanging in there.
Yeah.
I saw a great concert on TV. I wish I'd seen it in person. It was a CBS special on the anniversary of Frank Sinatra's 100th birthday. And they threw a huge party at the Wynn casinos out in Las Vegas, and they had all these country singers come sing, all famous singers of all types, really, and sing a bunch of Frank's old songs. And Celine Dion came and sang, and she sang the song that is titled All the Way. And she talks, and in the song, it's Frank's song. She sang it a little different than he did. But it says, when somebody loves you, you want them to love you all the way, like all the way to the end of your life. And there's a line in there, and she says it so good. She says, for all those good and lean years. And then she kind of waggled her hand, and all those in-between years. And anybody who's been married for a while knows that there's good years, there's lean years, and there's some in-between years. And that's awesome. But the beauty of the journey of finances is there are good years, there are lean years, there's a whole bunch of in-between years. And that's where it is important to stay on the journey, to be hanging in there. So that's a great part of this success story that I wanted all of our listeners to hear, is to say, just hang in there. On this Monday, can I offer you a word of encouragement? It's toward the end of the month. They're listening to this podcast. Maybe you ran out of money 7 days ago. You're trying to make it to the first of the month. Hey, hang in there, because hanging in there is 90% of this thing of winning with money. And when you do so, it will be a good thing, and you'll allow yourself the joy of succeeding long term. So thanks for sharing your success story, Dana and Laura. You're doing fantastic. And we want everybody to be able to share that story of being able to hang in there for the long term. Way to go.
Awesome. Okay, so now we're going to get to our top money questions for the month of April. So our first one is...
And I'm supposed to answer these fast, right? Rapid fire?
Ideally.
Ideally. We'll see. That's a tough test for me.
That is a tough test. All right, number one, how is insurance on my car loan calculated?
Interest.
Interest.
How is interest on my car loan calculated? Well, it's simple, and this is generally how every interest is calculated on any type of loan, not just a car loan. They look at your outstanding balance for the month and take it times the interest rate that's charged, and that tells you what interest is due for the year, and they divide it by 12. Okay, so they probably have a daily interest rate that is the entire annual interest rate divided by 365 days, and that is your daily interest rate. But let's say you have a 5% car loan and you have $10,000 outstanding. Okay, so $10,000 outstanding at 5% divided by 12 months, that means you're going to pay about $41.67 of interest. And that's how they calculate it. And it's usually based on your average daily balance for the month. And so it depends on when you pay your payment. Obviously, if you pay your payment earlier in the month, the average daily balance will be lower for the whole of the month versus paying it in the middle of the month. But that's how they calculate interest. And they charge you. And so how do you lower that interest? One way is to get a different interest rate on that loan to refinance it. The second way is pay that principal balance down. The sooner that balance goes down, the lower the interest rate that they can charge you. And it allows more of your payment to go to balance reduction.
All right, question number 2. What type of life insurance should I purchase?
Okay, so there's two primary major groups of life insurance. One is called term life insurance. Another is called whole life insurance. Mm-hmm. Now, there's derivations of each.
Yes.
But that's the two major categories. Term life insurance, and I'm confident we're going to have an episode coming up soon on this topic. If not, we need to get it on the list. But term life insurance is for a set term, and if it's level term life insurance, then it will be the equal payments for the entire term. So, for example, I have 30-year level term insurance, and that means it's for 30 years. It will pay the face value of the policy if I die prematurely during that 30-year period, which I'm rooting against.
Yes,
and
we all are.
I have a level term payment. So the payment will be the same this year, next year, and for all 30 years. If I win the bet and I live beyond those 30 years, that insurance expires and I don't get any money back and it's gone. But it's super cheap. And that's why I recommend level term life insurance, 20 to 30-year level term life insurance equal to 10 times your annual take-home pay. Okay? And if you have a non-income producing spouse, like a stay-at-home spouse, a minimum of $250,000. Whole life insurance is expensive because it has life insurance, but it also has an investing component. And it's super expensive. It does have some reasons that some people should maybe consider it. But when you're just starting out in your financial journey, term life insurance is so cheap. And I personally like to keep my life insurance and my investments separate. However, there are some tax advantages to some whole life insurance policies that particularly for people that are highly compensated or they have maxed out all their other retirement vehicles, this can be another appropriate retirement investment vehicle, whole life insurance policy. So that's a fast answer to a complex issue, but I prefer term life insurance for 20 or 30 years. And the way I calculate whether it's 20 or 30 years is I say, how long is it going to be till my last kid is out of the house? So my youngest is 5 right now. She ought to be out of the house in 20 years. Can we agree? 20 years, 25? She should be gone.
Yeah.
And so my 30-year coverage will last beyond that. And so I'm good.
All right. And episode 14, we did do whole versus term life insurance.
Episode number 14, y'all.
Yes. We'll link it in the show notes. But I went back and looked because I was like, I'm pretty confident we've done it. And then episode 15 was what type of insurance should I have? So we break down both of them. So we go through the whole versus term, and then episode 15, what type of insurance should I have? So both great
episodes.
Amazing.
We've done so many episodes now that I've forgotten that we've done them.
I know. Well, you're talking about it. I'm like, I think we've talked about this, but so I went back and checked
but
just to make sure. I
also teach you all these live events and everything, and I'm answering questions, all this stuff, so it all blends together. It's amazing.
It's amazing that we can keep any of this straight. Okay, our next question. Should I focus on investing or paying off debt? We get this question a lot.
Yep. Should you focus on investing or paying off debt? Both are very good decisions.
Yep.
Let's just leave it at that to start. Both are great decisions. Reducing debt, investing for long-term dreams, retirement, college, things like that. Both are fantastic. I point everybody who asks this question to the I Was Broke Now I'm Not ladder,
Yep.
which is available at iwasbrokenowimnot.com/ladder. We'll have a link in the show notes. It's also in chapter 4 of my book, I Was Broke Now I'm Not. Buy it on Amazon now or on our website. But here's what I want you to know. We put things in order, and we start by saying rung number 1 is to write down your plans, hopes, and dreams. Rung number 2 is put 1 month's worth of money into savings, 1 month's worth of expenses. And so after that, invest enough to get the company match, okay? So if you already got your plans, hopes, and dreams written down, you've saved up 1 month's worth of money, then at least invest enough to get the company match from your company retirement plan. And then rung number 4 is attacking all non-house, non-business debt. So generally I say, of course you're paying your regular debt payments, so you're going to pay your minimum payments all the time, but you start focusing on paying off with extra money and after you've started contributing enough to get the full company match or $100 a month into a retirement account.
All right. Our next question. How much money do I need for retirement?
A lot. That's the number one answer I get
Next
when
question.
I say, how much money do you need for retirement? And they all go, a lot. And they all get this weird look. And I say at our events, I said, this is when we're going to invite Sister Carrie Underwood to come up and sing that old hymn, Jesus, Take the Wheel. It is such a huge number, and it's a profoundly scary number for many people because of lack of knowledge or because they're starting so late.
Right.
And so I encourage everybody to use a calculator. And I've got some calculators that I've included here from Voya Financial and from Fidelity. And I also have included the one from our website. And they'll be included in the show notes. But these are great calculators for you to get an indication of whether or not you're on track. I'll speak to it quickly. You need to have at least 3 streams of income, ideally, set to come to you. 3 streams of income at retirement. One of them can be Social Security. Another could be a pension. Another could be your retirement account. Another could be a rental house that's paying you rents. Could be a small business or a franchise or intellectual property license rights. Maybe you're a musician and you have artists, you get different ASCAP or recording industry payments. The bottom line is you need to have, in general, about 10x your regular income in your retirement vehicles or in the net worth income producing assets.
Shoo.
If you have 10x that, so if your annual income is $75,000 a year, if you have $750,000, you're well on your way. But that is a simple answer to a complex issue. But in general, take your annual income and add a 0 to it, and target that for your retirement accounts and the overall net worth of your income producing oxen. And I'm referring to oxen after the book I've written, which are financial, income generators for you.
All right. Our next question.
That is a very complex question.
That is complex. What should I do if I get laid off?
What do you do if you get laid off? Well, if you hated your job, celebrate and high five somebody and freak out your boss. That'd be great. If you loved your job or you really need the income from it, I'm going to assume it's that. It could be bad. It could be a combination of all of them. But if you get laid off, and if I got laid off, the immediate thing that I would do is I immediately run towards all the things I can control. And I feel like that's good stewardship. And rather than wringing your hands worrying about should I'm just like, let's get it over with. If there's surgery and I've got to have my arm cut off, let's cut it off today. Like it's got to go. Then make it go away. If I have to spend money on something that's broken, take my money now. I need to break up with it because it's kind of like the difference of, a serrated cut or a clean cut. Serrated cut is harder to heal, and that's kind of what happens when you delay decisions. So I race towards immediately eliminating all unnecessary expenses. If I'm laid off, I'm cutting out cable. Netflix is gone. Hulu's gone. Amazon Prime for sure is gone. That's like an outrageous impulsive credit card device. And then I'm setting the furnace to a lower temperature. If it's in the summer, I'm bumping it up a few degrees with the air conditioner. I'm doing everything possible to save money. We're not going out to eat. I'm cutting out cable. We're not going to the movies, and we're stopping contributions to, retirement accounts and all that stuff. Why? Because I need to make sure that what money I do have saved is going to last for the longest possible period of time. Does that make sense?
Yep.
It seems extreme, but here's what I know. When you reduce necessary expenses to bare minimum, it allows you to operate with a better mentality facing your future. So I always look at it with this mentality. I don't know when this issue, being unemployed, is going to be resolved. So let's make all the hard decisions right away so I minimize financial agony. And look, maybe you get laid off and you get a severance. That can be a huge blessing, but it is not the right answer to say, I got a severance, so I'm not going to change anything financially.
Right.
Because that severance could end up lasting you, maybe it was 3 weeks worth or 6 weeks worth or something like that. But it could actually last you double that amount if you got after it and made some appropriate, hard financial decisions right away. And that can really be a huge help to you, because when you're interviewing and you're desperate, you behave differently. It's like weird. And it also allows you to avoid just taking a job just for a job.
Right.
It allows you to make sure that you can go get the next job that is going to really help you advance forward in your life and towards your dreams.
Okay. Our last question. How do debt consolidation loans work?
How do debt consolidations loans work?
Consolidation.
I love how you said that. The reason Megan is saying it that way is she doesn't even know really what that is, because she's never done that. I, on the other hand, have done debt consolidation loans. And so that's why Megan's on this call, to make sure that she speaks to all the people who've never had all these hurts and hangups when it comes to money. But the bottom line is, I haven't had those issues for over 16 years. But here's how a debt consolidation loan works. Is it ideally consolidates a bunch of higher interest loans into one single loan at a lower overall interest rate. So it therefore results in a lower payment. It's not always a good thing, however. One of the greatest tragedies that we see in our office and on the road when we're traveling and speaking is that people will take a debt consolidation loan. So they might use home equity in their house and roll in their credit cards and furniture loans and all that, maybe a couple cars. And then they don't change the financial behavior that led to all those debts in the first place. And a couple years later, here they are with more house debt, and all these other debts on the credit cards have grown back. Why? Because they thought they did something that was a positive financial decision with the debt consolidation loan, but they failed to recognize that what they really needed to do was focusing on changing financial behavior.
Right.
If you don't change financial behavior, no amount of churn, which is what this is called when you move debt from here to there and over there, no amount of that will fix poor financial behavior. And so that's how they work. And people do this with their student loans. They do it with credit cards. It can be a positive thing, but only if you changed your financial behavior.
All right. So for our helpful tools today, you mentioned a few of them, but we have a couple of different retirement calculators. So we'll link all three of those so that you guys can check those out.
I feel like I answered these questions today pretty effectively. Is that good?
Yeah, you did good. Congratulations.
Yeah. And so listen, we want to hear all your other questions too, because at the end of the next month, it'll be here before you know it. We'll be doing another episode of that. So can I ask you some hot seat questions?
Yes.
Yes. Briefly.
Couple minutes.
I'm going to just throw you into the hot seat because this is probably your last episode. We might record another episode, but I don't think so before the baby shows up.
I don't think so.
But who is a big role model in your life?
It's a tough one. I probably would have to say like my parents.
Your parents?
They I love watching their marriage. I think that's been really cool, and seeing how like Jordan and I brought both of our parents' marriage into ours. We both have great parents that are still married. And then I think the way that they handle their money specifically was a good model for me. Yeah. And probably is why that I am the way that I am and saving.
and we can all collectively, as we listen, go, "Aw," because how awesome it is. Isn't that what you want your kids to say about you?
Yeah.
Is that you're one of their role models in their life? That's pretty awesome. And tell everybody about your best vacation you've ever taken.
Oh, man.
I think I know what this is, but
That's so hard. Because like, oh man, we've been on some great ones. So we've done Israel, which was awesome. We've done that twice. We've done Greece and Turkey. So
that's the one I thought it would be.
Yeah. So
was it Santorini?
Yeah. So we did Greece and Turkey. So we did like biblical side of it. We did the life of Paul, but then we also did like a Mediterranean cruise while we were out there, which was incredible. So you're just cruising on a cruise ship, and you always get to see like the Greek islands as you're cruising along, which I love. I'm not a huge fan of cruises. The middle of the ocean, I don't know. Fear drowning, whatever. But you could always see land, and it was so beautiful. And we stopped in Santorini and got to see the sun go down like from the top of this beautiful place. So that was unreal.
It's awesome.
Yeah. And then we've been to Petra and gotten to see like that. It's like one of the wonders of the world, which is crazy. And then we did St. Lucia for our honeymoon. So that was kind of like a different trip. But so we've been a lot of really, really cool places.
Yeah. And no doubt ever chase you home on any of them.
No, none.
And so we're going to have an upcoming episode of how Megan and Jordan have went on a bunch of debt-free vacations. It'd be awesome. But listen, in our next episode, we're going to be talking about college money. College is expensive. And next week, we're going to discuss some different strategies on how to pay for higher education, whether it's yours, your children's, your grandchildren's. And listen, you don't want to miss this episode. It is very powerful. And when I travel and speak about this on the road, this is the one that gets all the questions. People raise their hands. They tune in. You can hear their ears, not hear their ears. You see their ears perk up. Kind of like Barkley, when you kind of whistle at him, his ears perk up. That's something that you're going to have. You want to listen to this. Don't miss this next episode. If you really want to help your kids or grandkids graduate from college without owing a bunch of debt, it's a huge issue for people, and we will help you address that in a very real and understandable way. Can't wait for that episode.
Awesome. So make sure if you like today's episode, leave us a ratings or a review. We'd love to hear that from you guys. And make sure you're subscribing to the podcast so you get those every Monday when we release them. Also, like we talked about earlier, we're going to be doing your top money questions again next month. So make sure you send those in. You can email us at info@iwbnin.com, and it could be featured on the podcast. And if you implemented one of our tips or you have a success story, make sure you share that with us as well.
Fantastic. Yeah. So hope you found this to be helpful today. As always, send us your questions. I love to answer them. Have a great week, and we'll see you next time right here Monday at the Monday Money Tip Podcast. Get fired up.
Thanks so much for listening to this episode of the Monday Money Tip Podcast, presented by I Was Broke, Now I'm Not. If you enjoyed today's episode, please leave a review and subscribe. And for more great content and to stay up to date, visit iwbnin.com. We'll catch you next time.